Hello. Energy markets moved higher this week as renewed escalation between the US and Iran reintroduced risk premium across oil, gas and power. While oil softened later in the week as traders took profit and assessed the likelihood of further escalation, gas and electricity contracts still closed higher than last Friday, supported by LNG disruption concerns, lower storage levels, stronger carbon and reduced renewable output at points. So let's take a look in some more detail. Oil prices began the week rising around 10% after further escalation in the conflict between the US and Iran and a renewed blockade of the Strait of Hormuz. Volatility increased during Monday's session as traders assessed a proposed 20% transit fee through the strait, although risk premiums eased after President Trump confirmed the proposal would not proceed. Prices continued to rise on Tuesday as the US reimposed its naval blockade on Iran, further reducing oil flows through the region. Additional support came from reports that Ukraine had targeted Russian vessels in the Black Sea, increasing concerns around another key export route for crude oil. By Wednesday, oil rose slightly following a larger than expected draw in US inventories, with stockpiles now around 6% below the 5-year average. However, prices opened lower the following morning as traders took profits and assessed the risk of further escalation. On Thursday, oil remains supported by continued uncertainty in the Middle East, with markets watching the possibility of Houthi disruption to the Bab al-Mandeb Strait, which could create a major choke point alongside Hormuz. Last night, front-month Brent closed at $85.26 per barrel, which is up $8.8 compared to last Friday. Gas prices also moved higher this week, with the sharpest gains seen in the near curve as geopolitical risk increased. Strikes on vessels travelling through the Strait of Hormuz slowed LNG cargo movements, tightening supply expectations and adding further risk premium. On Tuesday, gas continued to climb alongside oil, although some gains were lost after the US scrapped the proposed Hormuz toll. The closure of the strait added pressure to Europe's storage position, with inventories still below the seasonal norms and injection rates around 14% lower than last year. By Wednesday, gas prices rose again as the market anticipated further escalation in the US-Iran conflict. Demand was also projected to increase while European LNG deliveries fell sharply and Asian LNG prices strengthened, highlighting continued competition for global cargoes. On Thursday, gas prices were mixed, with some contracts gaining while others found weakness. The market remains highly sensitive to geopolitical developments, storage progress and LNG availability. All gas contracts closed higher than last Friday, with the biggest gains being seen on the near curve. Winter 26 gained 15.7 pence per therm, while Winter 27 gained 5.4 pence per therm. Power prices gained at the start of the week, driven by strong movements in gas. Further out on the curve, gains in UK carbon prices added further support. On Tuesday, electricity continued to rise alongside the wider energy mix, with bullish gas and carbon markets acting as the main drivers. Prices also continued to firm in early trading. By Wednesday, power rose again alongside gas and carbon. On the prompt, lower renewable output increased demand for gas-fired generation, with wind expected to fall below average. UK wind output was forecast to decline by around 36% to 3.1 gigawatts, adding further support to prompt prices. On Thursday, gas for power demand was expected to reach 28 MCMs on the day ahead, while elevated wind output and above normal solar helped to balance some of the near-term pressure. Electricity closed higher than last Friday. Winter 26 gained £10.3 per megawatt hour, while Winter 27 gained £4.8 per megawatt hour. You can download the full version of this market report from our website. Thanks for watching. See you next week.